Hello and welcome to Chapter 8. We're going to talk specifically about current and contingent liabilities in this chapter. Current liabilities are going to come due within a year typically. Let's talk just a little bit about them. Learning objectives from this chapter, we're going to explain liability recognition and the measurement criteria for liability. And we are going to look at how to identify and record different types of current liabilities. Look at something called contingent liabilities, which are liabilities that may or may not occur. We'll look at and how to measure warranty liabilities and warranty expense. And we will analyze the liquidity ratios using the current liability section of the balance sheet. Current liabilities are liability or obligations that are expected to be retired or paid really within 1 year, generally speaking. Um, and typically it's going to be 1 year or an operating cycle, whichever is longer. And you might say, well, what company might have an operating cycle that's longer? Well, think about companies that make spirits like Jack Daniels or wine companies. Their operating cycle is going to be longer because the alcohol has to ferment. Um, but anything that's not considered current is going to be considered long term. And contingent liabilities, and those are contingent on events, and we'll get into some more details of those, can be, as the slide here says, iffy in two ways. They may not turn into actual obligations, and for those obligations, the timing and the amount must be certain. So you have to know how much it is in order to report a contingent liability in your balance sheet. So liabilities are probable future sacrifices of economic benefits. Translate that generally into money, the last part, even though it says economic benefits. They arise from activities that happen within the business, and they occur when you transfer assets for somebody. And they have multiple characteristics. It really depends on what's driving it. We'll talk specifically about accounts payable, notes payable, payroll taxes, sales taxes are a couple of those that we're going to touch on just a little bit. And you notice here it says doesn't involve a payment, but typically it does. For the most part, you're going to see a payment of some type. And you notice in the bottom, this last one says a contingent liability is dependent upon future events. Think of, for example, a lawsuit. McDonald's get lawsuits for burning people with coffee. Well, that was a contingent liability. Eventually, they established it and they paid that out. But it was contingent on a future event. Another one that you're very familiar with is a liability that's driven by um, warranty, for example. Some of us buy stuff with a warranty. Well, a warranty liability is a contingent liability. We'll get into some more details of this a little bit later. Let's press on. Characteristics of a liability. Big thing is payment in cash, typically required cash, but not always. There's certainty, they know exactly how much it is. And it's legally enforceable. There's probably probable claims, and you have to pay a recipient, and you typically know who that is. So if we were to kind of put this in terms of what we would see, a current liability might be your cell phone bill. It might be your the what you're paying for your car each year, even if you have a 4 year loan. The current year that you're paying would be a current liability. That's typically how you would look at current liabilities. And if you have liabilities that have interest, the total payment is going to be principal plus interest times the period. So the amount of time is really what they're saying. This last one, it's principal times interest times time, where it says period. So if you had an example, if your principal is say $1,000 and your interest rate is 10%, and your period is 6 months, so half a year, your period would be 6 divided by 12. So you're going to pay $1,000 plus 1,000 times 0.10 times 0.5, or another 500, another $50. So you're going to pay $1,050 if you had something that you owed for just a year, for 6 months. And you notice that sometimes companies show that they have zero interest. That might be a no interest loan that you can't see the interest amount, and that's going to be included in the amount. If you have current liabilities, they require the payment of future cash, same kind of stuff we looked at already. So, and they occur within an operating cycle, and generally it's going to be less than a year. We touched on that a little bit. And you notice some companies will have a super long list of current liabilities, where others will kind of net all those together and call them just current liabilities. One of the big ones is accounts payable. Think of this like a bill that comes in every month for you personally. If it comes into you every month personally, that is pretty much going to be accounts payable for your personal finances, and it's going to be the same for business finances within a company. You typically won't get a bill, for example, every single month for your car payment. You might only get a new payment book every year, and the same thing with your mortgage for your house. That kind of stuff is what we would think about on an individual basis. The same holds true. The bottom one, you notice where it says it does not require a formal agreement or contract. There's no such a company extends credit to another company based off of their ability to pay. They look at their financial statements, but they do not have a formal agreement. They send them the product or whatever they're going to send them, and then they send them a bill afterwards based off of their credit. And that's really kind of the formal agreement, really, there is when you sign a bill stating that you've received the goods or services from the sender, that means that you're going to pay them. That's kind of the most formal of the contract that you have, which is not formal at all. You have accrued liabilities. Accrued liabilities are generally driven by adjusting entries. And in this case, what we're talking about here is wages that they pay for $10,000, and it says that they pay them for every day worked. So you might have adjusting entries for this, and in this case, it's $10,000 per day worked, and they pay every other Friday. So this is one example of where you would have accrued liabilities, and here's a prime example. Remember we talked about in the last slide that it's 10,000. Well, you notice that the month end or the year end falls on a Tuesday, so you would have to accrue 7 days worth of wages, 5 days for the first week and 2 days for the second. That's where you get 7,000 because you don't pay them out until the end of the second week. But you want to follow a principle called matching, where you're going to match revenues and expenses. That's where this $7,000 comes from. It's 5 days for the week prior and 2 days of the current week. So that's the first adjusting entry. And then when they pay them on January the 3rd, which would be that Friday, what they're going to do is they're going to cancel out this payable, the 7,000. These two relate. Notice wages payable and wages payable. And then they're going to report the expense that they incurred in January. So you have 10,000 and 10,000, and there's your amount. Okay. So we've matched now this 3,000 for the revenue that was generated in January, and this 7,000 for the revenue, actually this 1,000 for the revenue that was generated in December. We're following the matching principle. That's why we're doing adjusting entries. A note payable, in contrast to accounts payable, has interest associated with it. And you'd sign a formal agreement when you do that. Sometimes you might do a mortgage or when you buy a car. Those are the types of things that you have, and they'll tell you exactly how much. And they'll specifically state interest rates. And it tells you most of the time they will give you something called an amortization schedule that says this is how much you need to pay every month in order to pay this off in the term that you have. And some of you guys will also see this, even though you signed something with your student loans, probably when you got them. That's another notes payable, a little bit different, but the same basic concept holds true. So you're paying a principal and interest when you pay stuff in. So here's an example. Fitch Auto Parts borrowed $100,000 from a bank on October the 1st at a 10% interest rate. So they borrowed it. They have 3 months till the end of the year. And it says the principal and interest are due in a year. So they only borrowed it for a short period of time. So we're going to do 3 entries. The first one is when they took out the loan. The second one is the adjusting entry for the interest owed, and the third one is when they pay off the note on October the 1st of the next year. So let's look at those entries. The first one, simply cash came in and we credit in accounts notes payable liability. The second one, the second entry is where they accrue the interest that they owe. And the calculation you can see on the bottom here is 100,000. So that's principal times interest, 10% times time, and it's 3 divided by 12. And notice all these interest rates are always quoted as a year. So that's why you see this, and you have a total of year 3 months in 2011 and 9 months in 2012. Okay, that's where the 2,500 comes from. On October the 1st, they paid 100,000, the principal of what they owed. They're extinguishing this. They paid 7,500 for interest expense. Remember, we're still following that matching principle because this 2,500 was an adjusting entry in the prior year. And you have this 2,500, And the 7,500 is for the current year in 2012. It's 9 months out of 12. This one at the bottom. So they're paying back 110,000 on the note that they owe. Okay. The effects of the income on the balance sheet. Essentially, what happens here is you have higher interest expense in each year, and there's the balance sheet, and you clear it out at the end of the year, and the cash borrowed. So these are the transactions. And notes payable, another thing you can see is sometimes businesses can't pay for stuff. So what they will do is they'll say, well, how about you convert from a accounts payable, which is typically going to be 30 to 60 days, to a longer period. So here's the first transaction. They sold supplies to this company for $25,000. Accounts payable and supplies. So this company brought them in and they recorded a liability. Well, what's going to happen is they said, well, no, we're going to convert this to a notes payable and charge interest because they can't pay. So they reported it as a notes payable now. And then they actually, when they pay it off, it was 7% interest for half a year. That's this calculation on the bottom. And you have 25,000 was the principal and 875 was the principal. And they paid back 25,875. And that's on the Gibson is the company that can't make the payment. And they paid their supplier, maybe it's Jones and Company, I don't know. And when they pay the amount, that's what happens in the bottom here. You also have current portion of long-term debt. Long-term debt, like your mortgage would be, you'll put a current portion in there because what you're trying to do when you put these current liabilities in a current status is you're trying to see if you have enough financial resources to pay your current liabilities with the cash that's coming in. So that's what we're doing here. And you notice here it says um, you notice it doesn't change, so there's not really a reclassification of journal entries that you need to do. Another one you have is sales tax, use tax, and excise tax. I'm not going to spend a bunch of time here, but essentially what sales tax is, and let's just use that one as an example, that your company or an organization is really a collection agency for the state. So if you went to a store and you bought a pair of jeans and you spent $100, and they said, well, we're going to charge you sales tax. And typically the sales tax, at least in Texas where we are, is 8.25%. If you spent $100, the sticker price on the jeans was $100, they would collect $100, $108.25, and they would remit the $8.25 to the state of Texas. The retailer is a collection agency for the state of Texas. And that's where businesses get in trouble is they collect money and then they remit it. If they don't remit it to the state, guess what? The state's going to come after them because they want their money. And that's really what sales tax is. And here's the numbers example of that. And this one's a little bit more confusing because it's got state and local municipal taxes. But you notice what it did is they sold 3,000 truck tires at $75 each. So you're going to multiply these two together, and then we're going to add another 7%. We're going to multiply 3,000 times $75 times 0.07 is going to get you the state sales tax, and 3,000 times $75 times 0.01 for the local tax, the city of Bloomington, Illinois. So here's the collection. 225 is the tires, is the tires times the 3,000 tires times $75 right here. That 15,750 is 75 times 7%, or it's really 225 times 7%. And the last one is 1% of the 225, and you add those together, and that's the accounts receivable. Now, when the organization pays the state, what they do is they extinguish these current liabilities called sales tax payable state and sales tax payable, and there's cash. And there's a whole big process about how they do that and how they remit it and the size of the company and all that sort of stuff. For what you need to understand that companies collect sales tax and remit it to the state. And they do the same thing for payroll taxes. Payroll taxes are a little bit different than sales taxes, but kind of the same. You really have, even though it's not labeled this way, I would say the employees and the employer each have certain taxes that they have to pay. One simple one that you see is typically it's called OASDI, or you might know it as Social Security, or sometimes they call it FICA. Well, an employer has to pay, they will take 6.2% out of your check for FICA, Social Security, OASDI, any one of those terms you can use. And they also take 1.45% for Medicare. And there's a cap on Social Security at $106,000, $106,800. But what happens is they take some out of your check and they take some out of, they also have to pay. But if you were to take a look at your paycheck, if your gross pay was $1,000, they would take out about 7% for Social Security, about another 1.5% for Medicare, and then they might have other deductions. They're going to take also federal income tax, and if you have state income tax, they're going to take those out. So all those things that they take out of your check, whether it's for the government or for you to pay for your insurance or for you to pay for your retirement, any of those things, those are all things that they generate a liability, and it's a current liability on the balance sheet of the company. And when they create that current liability, they have to pay that sometime in the near future. And that's just on the gross to net of your paycheck if you were to look at your paycheck stub. And then on the business side, they have liabilities that they have that they're responsible for. The most obvious ones are the matching of the Social Security and the Medicare, and you might also have them with your 401k or some of the other stuff that they have, and those are called payroll tax expense. So let's take a quick look at some of this stuff. And what I want to point out to you before we look at the journal entries, this is something that you might find interesting, and it could help you if you're trying to run a business. You say, well, how's that? Well, look here. It says, if you look at the breakdown of the pay, and I know this is a little bit old, but I'm certain the concepts and the percentages are going to be the same. So let's say you were going to pay an employee $10,000, $10 per hour, just to get an idea. Well, you would know that you would have to add 8.2% to them for Social Security, that's FICA, and approximately 7.8% for insurance, 6.8% for paid leave, 3.4% for retirement, and 3% for supplemental pay. And supplemental pay generally is like insurance stuff that the company pays for, like health insurance and some of those kind of things. But if you add all those up, it's what, 16, 23%, 26%, give or take, about 30%. So if you pay an employee $10 per hour, in fact, it's going to cost you $13 in order to pay them by using these percentages, ignoring the one on the top and looking at all the others. That's going to give you a pretty good idea of how much it's going to cost you to employ an individual. Now let's look at a journal entry. Now you notice here it says employers not only withhold taxes from the employee's gross pay, but also amounts above gross pay. So what we're looking at here is they say McLean County Tire's hourly employees earned $48,500 in the pay period ending March 31st. So what that means is that's collectively all the employees that McLean County Tire has. It's a whole bunch of people, and it ends in March 31st. And notice here it says income taxes. So they're collecting this either for the federal or the state government. And then they have unemployment taxes that they also have to collect. Um, and pay. So those are a couple of things that they want to take a look at. So let's look at our journal entry. The first one's going to look very, very similar to what your paycheck would look like. Well, let's say, for example, you made $485. Now, this is everybody, but if you made $485, then your deductions would be two over. And really, what would happen is this would be your gross pay, this top one, and this bottom one would be net pay. Looks very, very similar. They took out income taxes, Social Security, and Medicare. Now, they didn't confuse this by taking out anything for health insurance or 401k or any of the other stuff, but this is the basic thing that happens. So all of these three are all as collection agencies for the federal government or the state government, depending, and they have to remit these. And you notice here it says employee and employee. Well, down here, take a look. This number and this number, these two numbers are exactly the same. What that says is they are matching, your employer is matching whatever they take out of your check, and they're remitting that as well. So when they remit the Social Security or FICA, they're going to remit for this particular pay period 3007 plus 3007 to the federal government for that particular thing, or $6,014, and the same thing for the 70325. The other two are for federal and state unemployment. You notice they don't take anything out of your check to put money into that unemployment fund. They just take it out and pay. They just take it out, and it's part of their responsibility. And you notice here it's labeled. These are all. Most of businesses will lump all these, and they will call these payroll tax expense. They won't separate each one of these as a separate line item, but the top part they will. But it helps you to understand what's going on with this. So if you're trying to say what's the total cost to employ all these people, It's really the summation of these and this to the employer for that particular month. And so that's how they calculate payroll taxes. The next one, you have unearned revenue. Unearned revenue is when people pay for something up front. And typically, they think of a couple of different things. If you prepay, for example, for tickets for a sporting event, or if you're going to get married and you're going to buy a custom made wedding dress, you say you need to give me a deposit of a certain amount of money in order to hold that dress. That's going to be a liability until they provide that dress for you, or until your team makes it to the playoffs and they go to that. And what they're doing is they're making a deposit up front to ensure that you do what you said you were going to do. And as a company, you do that because you want to make certain that you're not going to go out and commit company resources and then find out that the employee can't pay or the person can't pay. So that's really the this unearned revenue stuff, and you do adjusting entries for that sometimes. In this particular case, they're talking about gift cards. So when you go to Lowe's, let's say you bought a gift card for your grandchildren at Lowe's for Christmas, or maybe Toys R Us would be better. Well, you might do it, and 20,000 other people might do it as well. They might buy $5 gift cards for their grandchildren. Well, what they do is they have these gift cards, and what they're going to do is they're going to show a liability when they sell them. They get cash in, and then they're going to create a liability that's called gift cards, and then they're going to deal with the redemption. So the first one is they had 100,000 in cash and unearned revenue, a liability. Then, as they're redeemed at the end of by the end of the next year, they've redeemed almost all of them. And then finally, they might have some other stuff. This other one they redeemed because they said they expired at the end of December 2012. So really, what they've done is they've taken that amount and its income, even though they didn't provide any goods or services. Here they provided goods and services. This last part says the expiration. Notice redemption and expiration. That's what happens with unearned revenue. Contingent liabilities are a little bit different than unearned revenue. Contingent liabilities are really um, things that come based off of the business. And if you notice, the event is contingent on it's probable and a reasonable estimate of the loss can be made. And lawsuits filed against the business are classic examples. So let's talk about one for a minute that some of you guys, I'm certain, had heard. Several years ago, somebody got money from McDade. They filed a lawsuit against McDonald's because they got coffee and they burned themselves. So the first thing that happened is the lawyers at McDonald's probably said, how ridiculous. People burn themselves with coffee all the time. That's not going to be a contingent liability for us. Well, it started to become a public relations nightmare, in my opinion, for McDonald's because this person was very vocal and their lawyers were very vocal. So it was not probable when she first filed her lawsuit, but after she filed the lawsuit and they became more and more vocal, it started to become more probable that they might have to pay it out. And then probably over a period of time, they're like, we can figure out about how much we're going to be willing to settle with this person. And once they knew that amount, when it was probable and it was a reasonable estimate, then they had to report it as a liability on their balance sheet. And you think, well, that's not fair. It's not. But sometimes in business, it was better for them to pay this particular individual some money to go away than it was for them to try and keep fighting the public relations battle that they were fighting. And that's just a simple example of a contingent liability. There's multiples of those, right? And here's a good threshold, and you can see the rules. I'm not going to read through all this stuff. You can pause the presentation right here and read through this stuff, but you can tell that this was like my McDonald's example, right? Neither record as a liability nor disclose. You didn't have to say anything about it because they thought it was so ridiculous or such a frivolous lawsuit it didn't really matter. The second one said that there's still no journal entry made, but here you have to report a journal entry because you know exactly how much it is. And so you can read through the rest of this stuff. But if you read through this and think about the example I gave you with McDonald's, you'll understand exactly what a contingent liability is. Now, another contingent liability is a warranty. A warranty says, and obviously you guys know this, a warranty says if something happens, think about a new car. If something happens within a new car, they will repair it or replace it free of charge. And really, what they're doing when they do those warranties is they're trying to figure out about how they make an estimate of about how much they think they're going to have as a defect. So when they sell cars, they know that they might have a 5% of the total value of a car's of cars, a car or cars sold, as a warranty that they're going to have to pay to get something fixed. Maybe the radio doesn't work. Maybe the air conditioner doesn't work. Maybe the airbags don't work. All those are warranty things that they do, and there's expenditures created with that. Now, I'm not going to go through the numbers on this slide, but essentially what happens here is Nolan offers a 12-month warranty on all computers, and the each of the computers they sold 2,000, and they expect it to be a $155 cost to repair. So let's take a look at what happens. They said, okay, you're going to have one failure. Here's the math for what they did. They said basically that they're going to set up a warranty expense. So expense all of it at the same time. They're following that same principle called matching. And then they have a liability that they establish on the balance sheet. Well, when they pay stuff out and they work on something, so what they did is they must have taken parts out of their inventory and they paid a certain amount of cash for people to repair stuff. Well, they're reducing to their liability account based off of that. That would be a warranty liability for a business. It's another example. So we want to look at we want to analyze current liabilities just to see what happens. And let's look at this top one. It's probably the most important, but there's others. Let's look at this top one first. And if you think about it intuitively, what's in the current assets are going to be cash, accounts receivable, and prepaid insurance and inventories. Typically, that's what's going to be in here. There might be a few other things, but that's pretty close. And the liabilities are going to be pretty much accounts payable, sales tax payable, payroll tax payable, some of those kind of things. Well, you will want to expect this number to be higher than one because if not, you're going to have a problem. And let's talk about it in terms of what you would think personally. Your current assets, even though it's not an asset, might be your current income, and your current liabilities might be what you owe. So if you make less than what you owe, in other words, this ratio is less than one, you're going to have a problem. And the same holds true with businesses. So if you have this ratio at less than one, they're going to have difficulty paying back their bills. And the quick ratio is just a smaller example, but you notice what's not on here is inventories or prepaids. So what they're doing now is they're looking at that same ratio, but it's at a lower scale. And then you have this next one that is just cash and marketable securities, because those can convert to cash very quickly. And each one of them refines this to a smaller level. And what it does is it helps the business understand, or the outside user understand, whether the business is going to have enough money to meet its current obligations. That's really what this is all about. So if you worked in a credit department for a company, you would look at these ratios as a determining factor of whether or not you would grant credit to a customer or not. Okay. And I'm not going to go through all the ratio calculations. You can look at the numbers here and it'll give you the solutions that you can see on the next slide. And you can figure out what the ratio is for each one. And so here's the solution for each one of these, and you can see the math. You can go back and forth by the slides. I don't think I need to read this. I think you can read through this and understand what's going on. That is the end of the lecture for chapter 8. I look forward to seeing you in chapter 9. Have a great day. Thank you.